Dear students and viewers, I hope you all are pursuing the goals of your lives. I've introduced this segment on my channel to regularly upload videos based on exam style questions about accounting, finance, economics, and business mathematics. Based on my teaching experience spanning over more than 3 decades, I believe that this approach of learning is the best for both beginners and advanced level students. So please subscribe to my channel and click the bell icon to stay informed about new videos. These videos will help you understand important concepts in a friendly manner to pass your exams and apply these concepts in real life. Today's question relates to the subject of economics. The question is, which of the following can be efficiently allocated between competing uses by the price mechanism? Option A, public goods. Option B, externalities. Option C, private goods. Option D, free goods. To correctly answer this question, we need to learn the concepts of price mechanism, public goods, externalities, private goods, and free goods. So let's begin with the concept of price mechanism. In economics, a price mechanism or market mechanism is the manner in which the profits of goods or services affect the supply and demand of goods and services, principally by the price elasticity of demand. A price mechanism affects both buyer and seller who negotiate prices. In simple words, price mechanism enables the producers to produce goods that yield higher profits and the consumers to buy goods and services at a competitive price. A simple example of a price mechanism is the situation when a company increases its prices due to an increase in demand of its product. The increased demand temporarily drives up the price of the product as consumers are willing to pay a higher price to obtain the product with a limited supply. This will result in increasing the revenues and profits of the company. What are public goods? In economics, a public good is a good that is both non excludable and non rivalrous. Use by one person neither prevents access by other people nor does it reduce availability to others. Therefore, the goods can be used simultaneously by more than one person. Examples of public goods include law enforcement, national defense, rule of law, and in some cases, public transportation that is offered free of cost or at subsidized rates. Public goods also refer to more basic goods such as access to clean air and drinking water. Typically, these services are administered by governments and paid for collectively through taxation. What are externalities? In economics, an externality or external cost is an indirect cost or benefit to an uninvolved third party that arises as an effect of another party's activity. Externalities can be considered as unpriced goods involved in either consumer or producer market transactions. The traditional example of a negative externality is pollution, where a polluter makes decisions based only on the direct cost of and profit opportunity from production and does not consider the indirect cost to those harmed by the pollution as a consequence of the production processes in the factories. Another example of negative externality may be the smoke that is emitted by vehicles on the road. So that's why certain governments may impose carbon tax on gas just to discourage people using gas, and they may switch over towards more cleaner energy sources like electric vehicles. Examples of a positive externality may be a situation where a farmer grows apple trees and provides a benefit to a beekeeper. The beekeeper gets a good source of nectar to help make more honey without contributing anything towards growing apple trees. What are private goods? A private good is a product that must be purchased to be consumed, and consumption by one individual prevents another individual from consuming it. Examples of private sector goods and services include broadband service providers, food shops, grocery items, mobile phone providers, car dealerships, and consumer goods companies. For example, those selling electronic items such as TVs, fridges, and laptops. What are free goods? Free goods are goods, whether consumer goods or productive inputs, which are useful but not scarce. They are in sufficiently abundant supply that all agents can have as much of them as they wish at zero social opportunity cost. Examples of free goods are air and sunlight. Unlike economic goods, free goods have no cost because they are not traded in marketplaces. Economic products have a price based on supply and demand, reflecting their scarcity. Now you have understood these concepts, so you can understand that the correct answer for this question is option C, private goods that can be efficiently allocated between competing uses by the price mechanism. However, the price mechanism that drives business activity cannot allocate public goods, externalities, and free goods in an efficient manner. If you have enjoyed this video, please do subscribe to my channel. Click the bell icon for notifications and also share and like this video. Thank you for watching.